Brian, I think you're driving the PowerPoint slide, right? And you've shared your screen with everybody here?
Yes, sir. You should be viewing my screen here. We're looking at the agenda right now. And with that, we're going to jump into part one, which is the section of today's workshop focused on jewelry coverage. Now, jewelry coverage is a somewhat minor part of an insurance plan for most people, but it's an area of the insurance policy that we frequently see claims. So it gets a lot of attention because you might not have $50,000 worth of jewelry, but the jewelry that you own can be worth enough that it can be concerning when something goes wrong. Now, a common thought that we hear in our industry is, well, I'm sure my jewelry is covered automatically, right? Derek, what's the answer to that question?
Yeah, the answer is right, but it's only automatically covered for fire. And a lot of people are under the impression that the policy is going to provide much better coverage for their jewelry, because if you look at a lot of homeowners policies, they'll have the word jewelry listed there under coverages. The problem is that they don't put a big asterisk next to it that says, hey, this is covered only with regard to very, very few instances, the big one being fire. So yes, it is automatically covered, but the thing that it's covered for is very, very unlikely to occur. So let's dive into some better ways to insure jewelry on a homeowner's policy.
Sure. So when you're talking about it being automatically covered for something like fire, you're talking about the personal property coverage, which applies to clothes and furniture and electronics, sports equipment, those household type of goods, which extends that coverage to your jewelry, but really it's only going to be if there's a total loss in a house fire. Is that what you're saying?
Yeah, that's exactly right. So you'll see here, there's an example of a homeowner's policy. You'll see the coverage amount on the dwelling. That's the house is $240,000. 2 lines below that is the personal property coverage of $168,000. That's 70% of the coverage on the home. That's typically what we see automatically included. So this person, based on the amount of coverage they have on their home, has $168,000 of coverage for their personal property.
Got it. Now, of course, with that coverage, you have a policy deductible, right? Which in a lot of instances is $1,000. So even in one of these claims where, yeah, your jewelry is covered for fire, there's a $1,000 deductible that's normally going to apply. So kind of in summary of that, Derek, what's the point of just your typical home insurance policy in terms of how that applies to jewelry?
Yeah, sure.
Good, bad, somewhere in between?
Yeah, well, the good is that it's automatically covered. Yes, the bad is that it's only automatically covered for fire. So like this slide notes here, provides coverage, but it's got to be destroyed by a fire. If there's something that happens to it, like theft, there's very, very minimal coverage, and the policy's deductible applies. A lot of people have $1,000 deductible on their homeowner's insurance. That wipes out a large portion of that claim in many, many instances. Now, the biggest issue is the bottom point here, the third point on this slide. A standard homeowner's policy doesn't provide any coverage for jewelry that is lost or misplaced or left at the hotel or falls off your finger while you're swimming in Lake Michigan. Those types of things are not going to be covered by your standard homeowner's policy. The good news is that you can choose to have coverage for those types of things, which I think we'll touch on here momentarily.
So what type of claims do you normally see when it comes to jewelry? I can't imagine it's a house fire. It's probably falling off of your ear. It's the necklace snapping. It's the ring slipping off in the snow. Is it that type of thing that we're concerned with?
That's exactly right. Or someone was shopping and they return home and the diamond fell out. Maybe they didn't lose the entire ring, but a substantial piece of it just happened to disappear.
Okay, so what do I do? What do I need to talk with my insurance agent about if I do own any jewelry that is, moderate or expensive in value?
Yeah. I think if you're looking at something that, like you said, is a few $1,000s or more, you want to specifically list it on your insurance policy. So previously we saw $168,000 of personal property coverage, but it didn't identify what was included in that personal property coverage. What we can do with jewelry is we can specifically list each item to say, we are insuring this 14 karat gold, diamond ring for $5,000. Or a pair of diamond earrings for $10,000. Whatever it be, you can specifically list each of your pieces of jewelry on the policy. And you'll see here as an example, we've got two rings listed specifically on the policy. You'll see the description there, as well as the limits, which is the amount of coverage on each of those pieces of jewelry.
What does that DED section that's circled indicate, Derek?
That's the deductible. You'll see here there's no deductible. So both items are going to be insured for pretty much anything that could happen to them. Like we said before, lost, misplaced, lose a diamond when you're shopping, drop it in the lake. And they're going to be covered for that coverage amount under the limit side with no deductible.
Got it. I like that. So give us the highlights of this scheduled jewelry coverage that you're suggesting we do with our jewelry.
Yeah, we typically refer to that, like you said, as scheduling that piece of jewelry. And again, it provides coverage for pretty much anything that could happen to that item, including something like an oops scenario where you just happened to lose it. There's no deductible, so that trumps the policy's deductible. Most people know a homeowner's deductible applies to pretty much every homeowner's claim. Specifically, scheduling your jewelry makes sure that that deductible does not apply to a claim on the jewelry. You'll see here it also provides coverage if the jewelry is stolen. We mentioned earlier that there's very, very limited coverage for theft of jewelry on your standard homeowner's policy. The third point here provides coverage if the stone falls out, mentioned that earlier. And from a pricing standpoint, it usually costs about $12 a year for every $1,000 of coverage. So if you've got a $10,000 engagement ring, normally you would see some type of premium impact of about $120 a year to add that to your homeowner's insurance policy. So
Got it.
Usually pretty inexpensive to add that coverage to a policy, which is why a lot of people choose to do that.
Got it. The benefit being you get these types of coverages for losing it, having it stolen, slipping off your finger, mysterious disappearance, and there's going to be no deductible on that claim, right?
Yes, I would say you get coverage for the things that are actually going to happen.
Not just the house fire.
Exactly.
Perfect. Now, in 60 seconds, just give us a quick summary of this alternative that is often available as an option. If I don't want to specifically schedule various items of jewelry on my insurance policy, I've heard that I can use blanket coverage kind of as a catch-all. What are the pros? What are the cons of using blanket coverage for my jewelry?
Yeah, let's say I've got, a collection of 50 different pieces and I'm always trading them with, relatives or buying new and selling an old piece. And they're all worth a couple $100. Well, if someone breaks into my house and steals that entire collection, that's a big financial burden that's now placed on me. But maybe I'm not interested in swapping those out on my insurance policy every time I make a change to my jewelry collection. So what I could do is I could have blanket coverage on my insurance policy where I would simply say, here's the total amount of coverage that I want for my jewelry. And I'm not going to specifically disclose how many items make up that amount of coverage, what the value of each of them is, et cetera, et cetera. So if I'm swapping one for another, I don't actually have to even update my insurance policy, assuming that those two items had a relatively similar value.
Got it. Okay. So it simply says, I've got blanket jewelry coverage of this amount. The downside, the limitation being that there's normally a per item limit that will apply there. So if I've got a $15,000 ring and I slap $15,000 of blanket coverage on there, that's not appropriate because there's usually going to be a per item limitation within that blanket coverage, making it more appropriate, like you said, for kind of the miscellaneous odds and ends where none of those items are really that expensive, but in total, you have a fair amount of value there, right?
Exactly.
And here's an example of what that looks like. So in this example, we've got two rings specifically scheduled, plus a $3,000 blanket jewelry coverage in there, kind of as a catch-all of the other smaller items that this client might own. What's the key point here, Dee?
Key point is that jewelry is something that every insurance agent should be asking their clients about because the coverage that's automatically included on a homeowner's policy is very, very minimal and it's not very effective. So it's certainly something to discuss when it comes to doing insurance planning. You should specifically list your jewelry on your policy or use a blanket if that's appropriate for the smaller items.
Perfect. Okay. Now to wrap up the section on jewelry, let's just take a really brief look at two different styles of coverage you can choose in terms of how your claim is going to be paid if you end up needing to make a claim on that jewelry in the future. Can you give us just a very brief summary here of stated value coverage, which is the default, most typical coverage, versus the upgraded coverage of agreed value?
Sure, absolutely. Stated value basically says the insurance company will pay up to whatever coverage amount you have listed on your policy to replace that item. They might pay a lot less than that. In many instances, they're buying all of their jewelry from one specific jeweler, and so they get very, very deep discounts. So they might be able to negotiate a price for that ring that costs you $10,000 of only $6,000. So what they do is they enter into agreement to purchase that exact ring that you had from the jeweler for $6,000, even though you had it listed on your policy for $10,000. They cut a check to the jeweler for $6,000. You walk in, pick up your ring. That's going to be worth $10,000, but the insurance company paid $6,000 for it.
Got it.
If the insurance company happens to have that exact same item sitting in their jewelry vault, they could theoretically reach into the vault and hand you that ring to replace it. So you only really get the full value if you're replacing that item.
So this is really most appropriate, at least in my opinion, for the engagement ring or some sort of ring that would never be converted to cash, right? Your wife is going to want to continue to wear and own an engagement ring. She likes the one you bought. So who cares what the insurance company pays to replace that item, as long as the ring that's being replaced is just like the ring that was lost, right?
Exactly.
Okay. And then let's take just a quick look at agreed value coverage. This just simplifies the claims process slightly in a sense that upfront, the insurance company is agreeing that the appraised value and the value you list on the insurance policy is what they'll pay in a claim. So if that item goes missing or is lost or stolen, they're just going to cut a check for whatever that coverage amount you see on the policy. Now, there's stricter underwriting for this coverage because, of course, they're agreeing upfront to the value that's going to be paid in a claim. So they do have some more strict documentation requirements upfront.
Yep, exactly.
Key tip D here would be that not all jewelry coverage is the same. So it varies by insurance company and by policy, and it's not appropriate for everyone to be just like someone else. So choose the coverage, work with your agent to make sure that that's designed the way that you intend.
Exactly. And speaking of not just like everyone else, that's a good segue into our next topic, and that is managing the cost of your insurance versus the coverages that you have. Obviously, both of those tend to go hand in hand. Higher coverage equals higher cost, less coverage is lower cost, but there are ways to strategically choose the coverages that really have the most value to you and that also provide the best bang for their buck when it comes to doing your insurance planning and making sure that your insurance fits well with the rest of your life and your other financial goals.
But hold on, I heard that a lower premium is always going to be the best option. Isn't that true?
Yes, it is. As long as you don't have to file a claim. The goal for all of us, or our hope, is that every dollar we ever spend on insurance is a total waste of money. We can get to the end of our life and say, I never should have bought insurance. I totally wasted my money on my insurance. That's great because you never had to pay a deductible. You didn't have to go through the headaches of, repairing your house after water damage, et cetera, et cetera. But the goal is always that, your insurance was just a waste of money.
Sure.
Fact is that's not usually the case. There's going to be a claim that comes along sometime in your life, and then you're going to want to make sure you have the coverage that you intended to help you get through, that financial burden that's been placed upon you.
Got it. So let's talk about that trade-off and how we can make sure that our insurance dollars are spent to be in the most impactful or most beneficial way to our own unique situation. First, I want to take a look at managing costs. And then after that, I want to look at managing coverage as kind of a supplement to the managing costs section. So why don't you tell us kind of the highest level, most useful ways that we can help manage our insurance costs over the long term?
Yeah.
What would you say those are?
I think one of the biggest ones is to avoid filing small claims. It's one of the hardest things for us to do as agents to suggest that someone do not use their insurance when they do have a real claim that we could submit to the insurance company. But we've seen too many instances where that ends up biting you in the butt down the line, and you think, gosh darn it, I wish I would have just paid that out of pocket. Avoid having yourself get handcuffed into one of those scenarios where you've got too many claims on your insurance history, you've seen a very, very drastic premium increase over the years, and now you're wondering, where am I going to reduce coverage to make sure that I can still afford my premiums. So
Sure.
avoid filing those small claims if at all possible. Now,
Got it.
not all of us have enough cash sitting on hand to be able to have that luxury, but if you do, and it works within your financial budget, for the smaller claims, it's going to be better off in the long run to pay those out of pocket.
Okay. Now tell us about insurance scoring. That's of course been a little bit of a dirty word in the insurance industry ever since it was adopted, 15 or 20 years ago now, but it's widely used. Every insurance company uses insurance scoring. It was deemed to be allowed. So insurance scoring has a big impact on what someone's insurance costs look like. And I understand that that's specific to them. It doesn't matter what type of house they live in or what type of car they drive or even what coverages they choose. How can we help make sure that we're establishing the best insurance score possible so that we can manage our insurance costs?
Yeah, this is probably one of the biggest, if not the biggest, determinant of the premium that everybody pays for their insurance. Like you said, regardless of how much coverage they have on their house, because it's a mansion versus a small little cabin, or whether they're driving a new Mercedes or an older Honda. The insurance score is a huge determinant of the premium that someone pays. So it's basically a credit score that each insurance company modifies a little bit based on their own criteria, and they've come up with their insurance score. So to keep your insurance score high, you want to do what it takes to keep your credit score high. Most people know paying bills on time, using auto pay, avoiding maxing out credit cards. That's going to help you do that. Keeping your credit score high is probably the best way to manage your insurance costs in the long run.
Okay. And then paying in full, of course, that's pretty clear. Most insurance companies have a somewhat substantial discount these days for paying premiums in full and upfront. And then multi-policy discounts, that's no secret. Everyone knows that using the same insurance company for multiple policies creates some efficiencies within their insurance plan. In certain instances, that's not going to be the case for whatever sort of underwriting reasons or other coverage needs. But 9 times out of 10, I think your suggestion is going to be using the same insurance company for as many policies as there are in play. Is that right?
Yeah, I'd say 99 times out of 100.
Okay. Now, to jump over here to managing coverage, we talked about how just in general, can we help make our insurance premiums as favorable as possible? What about the coverage decisions? What are we balancing here, and how should we be thinking about that?
Yeah, well, I think that, it's important to do a review of the coverages with, an agent or someone that has a thorough understanding of them, so that each person is able to determine what coverages are actually important to them. The best way to figure that out is to hypothetically say, what could go wrong? If I look at my house and I've got enormous trees next to it, well, I'm a little bit concerned about tree limbs falling on my roof. If I'm in a brand new neighborhood without, that type of thing, maybe I'm not concerned about that. An older house versus a newer house, those homeowners just know that there is a different, group of things that can impact, the house and what could potentially damage it. So focus on your scenario and what could potentially go wrong for you.
Now, when you talk about that, Derek, you're talking about physical damage coverage, which would be on your home insurance, your auto insurance, your boat insurance, the things where there's damage to the property you own. But a lot of us are most concerned or adequately concerned with, what about the potential of being sued and having a substantial lawsuit against us that would either eat up our net worth or would eat into our future earnings? Is that a consideration as well? On top of just the physical damage type of coverages we're talking about?
Absolutely. You're concerned about two things primarily. Number one, the physical damage to your house, your vehicles, etc. Do you have enough coverage to be able to have those things paid by your insurance company so you don't have to liquidate investments, don't have to, take out this huge loan to try to pay for repairs to your house, do these sorts of things. So you're concerned about managing cash flow when it comes to the damage to your possessions.
Okay.
The next thing you're concerned about, though, is what's going to really, derail my financial future. That's going to be that large lawsuit against you. So you need to consider, what is my occupation? What are my future earnings? What is my net worth? Are people aware of that? If they're aware of that, you're much more likely to be named in a very large lawsuit. So you need to
Yeah.
evaluate your exposure to a large lawsuit, and then you need to plan accordingly based on the fact that we live in a very litigious society these days.
Sure. Okay. And that brings up the umbrella policy, which we're not going to touch on today, but that will be a focus of our next workshop coming up in February. And that is a great supplement, very inexpensive insurance policy to help put some extra firepower into that liability coverage bucket.
Yeah.
Now, this next point here, appropriate deductibles on your insurance policy. Sometimes it makes a lot of sense to choose a higher deductible. It brings the premium down substantially. And like Derek said earlier, we don't want to file small claims anyway. In other situations, maybe I simply can't afford a higher deductible. If I can't cough up that money out of pocket when I need to make a claim, then I don't have that option of choosing a higher deductible. And in other situations, there's not enough premium reduction for choosing a high deductible to really even make it worthwhile. Why would I choose a $2,000 or $5,000 or $10,000 deductible if it only brings down my premium by $22 per year? No, I'm not planning on having a claim, but if I do, that's a much larger out-of-pocket expense, and I'm really putting very little back into my pocket by reducing my premium on an annual basis, right?
Yeah, you're exactly right. There needs to be a cost-benefit analysis when determining what coverage levels you choose, what size of a deductible you want, et cetera, et cetera. Like you mentioned
Sure.
at the beginning of this, a lower premium is always better, right? Well, in some instances, sure, but in others, no. Like you said, am I going to increase my deductible from 1,000 to 10,000 to reduce my premium by $40 a year? I don't think so. And again, that's my own personal preference. Everybody can make their own choices for their insurance, but most people would probably say there's not enough benefit there and the cost is too high. It doesn't make sense to make that.
Sure, got it. So point here is that there's no wrong answer. Your insurance is specific to you. It's specific to your assets. It's specific to your financial plan. It does not need to look like your neighbor or your coworker or your sister-in-law. Your insurance is going to be specific to you and what your goals are going ahead. Anything else that you want to add there, Derek?
No, I think you nailed it. I think you said it very well. Focus on damage to your items and the deductibles that you're going to have to pay. So short-term cash flow planning, and then look very long into the future about your financial projection and how much lawsuit protection is appropriate for you, given your net worth, your current earnings, and those future earnings that you're going to have down the line.
Okay. Well, we're coming up on 25 minutes here, so we want to be cognizant. Why don't you take us home with your recommendations, Derek? 2 on the jewelry side and then 2 on the cost versus coverage side. Hit us with the jewelry recommendations.
Sure. Talk to your agent about it. Say, this is my jewelry collection. This is what it's worth. How do you think that I should insure that? Is it listing each item? Is it using a blanket? Your agent's going to be able to help you determine how should you cover your jewelry. Second tip is document. It's very hard to say that you lost a piece of jewelry that hasn't been appraised in 20 years and there's no documentation for it. If you get an updated appraisal, send it to your agent. We'll keep it in the file. Have photos of your jewelry, et cetera, et cetera. The more documentation, the better.
Got it. Okay. And what about managing cost and coverage?
Yeah. Understand that there's a trade-off. If you're going for lower cost, you're going to probably have lower coverage. And that's okay if that's your choice. You just need to be cognizant of the fact that the rest of your financial plan needs to incorporate the fact that you might have a high deductible for damage to your property. You might have an uncovered lawsuit, et cetera, et cetera. Choose coverages and deductibles that meet your goals and are appropriate for you. Some people are very, very risk-seeking. That's great. Their insurance should match their preferences with regard to that. Others are very, very risk averse, and they're going to have insurance that's much, much different than the person that's risk seeking. So know yourself, make sure the insurance meshes well with your personality and your lifestyle, and then have the insurance coordinate with your larger financial plan. So as we discussed before, you have the cash flow available to meet deductibles, pay off an uncovered lawsuit if you're ever in that instance, et cetera, et cetera.
Got it. Okay. Well, thanks for that summary, Derek. At this point here, we want to express our great appreciation for you being with us today. We know you have as busy of a schedule as anyone else. We hope that this was informative and educational and gives you something to think about when you're looking back at your own insurance plan. We really appreciate you working with us. We appreciate your trust and all of the feedback you provide to our agency, and we certainly value our relationship. Derek and I are going to hang out here. We will stick around. We know we've committed to a 25-minute segment here, so we will wrap up. So those of us that need to take off and head back to our work day or hopefully get off for the weekend, please feel free to excuse yourself. If you have questions or would like to chat, Derek and I will stay on here for as long as we have anyone that would like to participate. So with that, we really appreciate you being with us and all your time and your trust, and we will be here to answer questions and talk more specifically with anyone that would like to hang around.